Some harder times are ahead for the UK. Adolfo Laurenti, Bank J, Safra Sarasin. UK's inflation data will be out on Tuesday. Due to the steep depreciation of the pound since Brexit, it is expected that inflation will rise by 1%. Are your expectations in line with this figure, or do you think inflation may even overshoot this forecast?
Well, we expect inflation to move up. Data for the UK have been highly volatile on a monthly basis, so it's very difficult to pin down a number for the next release, but we definitely have an expectation to see the numbers going above 1% on a year-on-year basis, already starting with this week's release, and eventually to peak around 2.4, 2.5 sometimes in the first quarter next year. We also expect that once the final decision on Brexit will be made in the first quarter of 2017, there will be some economic implications that will probably slow down growth in the UK. Has been surprisingly resilient so far, but some harder times are ahead, and we think that may contribute to keep a lid on inflation, at least in terms of wages and salaries pressure. But when we look at the pound, there will definitely be some pass-through, and they are already beginning to bite right now.
On Wednesday, we have the highly anticipated US Federal Reserve rate change announcement. Markets have been largely expecting the Reserve to raise rates for some time, and that has only been strengthened by Donald Trump's election. Do you think a rate hike is a guarantee?
Yes, at this point we expect a rate hike to be guaranteed by the Federal Reserve. The latest employment report really fit into the pattern of data the Fed was expecting in order to deliver this hike. I have to say this is in part due to this upswing driven by expectation for the new administration, but it's not only that. We have seen really a strength and a momentum in manufacturing in the service sectors on the consumer side, much broader than just the expectation for the new administration. So the Fed is in a very comfortable place to deliver this hike as promised. Labor market continue to improve. Going forward, we expect some word of caution. We, in particular, have been disappointed by the weak reading on wages and salaries. This is something the Fed is watching very closely because it's giving some idea about how much slack is persisting in the U.S. labor market. Based on last month's reading, there might still be some way to go, and that will probably suggest to the Fed not to overdo the hiking next year. We expect 2 hikes in June and December. There might be some upside risk for a third hike if inflation readings will be stronger, which is a real possibility. But overall, we do not expect a statement by the Fed on Wednesday that will rattle markets.
On Thursday, the Swiss National Bank will also announce whether they will keep its interest rate at the record low minus 0.75%. Do you think they will maintain this rate as is the expectation? And what impact do you see this having on Switzerland's economy?
For this week, we expect the Swiss National Bank to stay pat and not to make any change in interest rates. But we believe that is a real possibility next year. We have seen the decision by the European Central Bank. Somewhat is a masked tapering, but it keeps the European Central Bank engaged with a program for quantitative easing. There are still risks on the European side, just looking at the Italian banking system situation. So chances are that the European Central Bank will remain in a mode of accommodation, and that of course is putting pressure on the Swiss franc, which is the safe haven for the region. That will eventually force the Swiss National Bank to do more at the beginning of next year to prevent an even stronger appreciation.
Thank you for your insight, Adolfo. So that's what to look out for during this week ahead. But for everything else on the FX market, stay with us here on Dukascopy TV.